Good morning to all of you. It's nice to see you once again on this Saturday morning. This is RN Bhaskar from BKBB, which is an acronym for Bhaskar Key Business Bhati. And yes, at 8:15 on Saturday mornings, we have news behind the news. But every Saturday, we also post our own regular podcast on an industry or a policy or a conversation. And this week, we are talking about a new policy on desalination. Do watch it. And yes, one more thing. As usual, we will discuss some key headlines during the last week. And please click the subscribe button. Please click the like button because it helps our algorithms with YouTube. And most important, please tell all your friends about us. Today, I have my co-anchors, Katya. She and I will discuss the headlines with the other co-anchors. And the other co-anchors are Janvi. Welcome. Husaina. And Saloni. Welcome all the four of you. Thank you very much for being here. And today we are going to discuss three very important titles. They are there on the screen before you. The first one, which is uppermost in most people's mind, will the rupee keep falling? The second one, which is equally important, is there's a lot of speculation whether oil prices will continue falling even below $30 per barrel by 2027. Will it happen? And the third one is China's strategic grip on minerals worldwide. Let's take the first story first. And Janvi, could you come in?
Today we talk about what's becoming one of India's most troubling economic signals of the year, which is a steady slide of the Indian rupee. So according to the latest data, the rupee has weakened to 89.30 against the US dollar, and we are inching dangerously close to the psychologically important level of 90. Now, if you look at the chart, the decline isn't a sudden fall. It has been a slow depreciation that's been underway since around July. And what's driving this is, of course, a combination of tariff related uncertainties and the resulting global supply chain realignments, and also the foreign fund outflows. So investors have been pulling money out of the emerging markets, and India hasn't been spared either. And whatever that happens, the demand for the dollar rises and the rupee takes a hit. So, despite the downward trend, though, the rupee has not crashed yet. It has moved in a controlled range, and it's because the RBI has been intervening, smoothing out the volatilities and preventing sharp swings. Now that has triggered into something else, which is that the IMF has reclassified India's exchange rate regime, and it has shifted it from stabilized to crawl like. So now what a crawl like regime essentially means is that the currency is allowed to move, but only within like a very narrow scope, roughly 2% over an extended period of time, like 6 months or maybe more. So in simpler terms, the IMF believes that India is not letting the rupee float freely, and that it's letting it only crawl gradually with the central bank nudging it along. Now, this also affects the investor sentiment, because if global investors feel that the rupee is too managed, then they'll worry about what will happen if that support is withdrawn. And also the crawl like pattern could be signaling that both the RBI and the government want to avoid a disorderly fall, especially when inflation on imports like fuels, electronics, fertilizers is already a concern. So what do you say about that, sir?
Well, the rupee has been falling. The government does not mention two factors behind the cause, behind the fall. The first is the slipping exports because India did not create new markets for exports. So your trade gap increases. Second, what India does not mention is that its domestic policies for attracting investors has not been good enough. As a result, more investors are putting money outside India than inside India. These are the two primary reasons why the confidence of foreigners to invest in India, even Indians to invest in India, has been declining. And lastly, earlier, the rupee used to trade within a 5 paise margin. Now it's trading within a 30 paise margin, which is why the IMF has reclassified. If you're floating rate, you can't play these games. And the RBI, if you look at the chart, the rupee has been more volatile under the present RBI governor than ever before. And also, the rupee is not being allowed to have its own level, so it's not really a floating rate currency. It's getting closer and closer to a fixed rate currency. Thanks, Janvi. Very interesting. But Katya, do you have anything to say about this?
So my question is it a good thing for exporters if rupee is falling? Because a lot of economists have said earlier, fallen rupee, devalued rupee is not a bad thing as such. What is your view on it?
Katya, you're absolutely right. I was talking to a forex dealer yesterday,
Mm,
and he was telling me, look, even exporters are too scared because they have to hedge against currency. If the
mm,
rupee is not stable, they don't know how to hedge.
right.
Suppose the rupee falls further, yes, they'll get
Mm,
the money, but the
mm,
foreigner does not want to pay that money till he knows what price is to purchase.
mm,
So everywhere exports have stalled because RBI is not clear and the rupee is not certain.
right.
It's frozen the markets for India. Imports have
Yeah.
become more expensive.
Mm,
Exports are not happening. Your trade gap is widening.
mm.
Okay, but
Yeah.
anyway, good story. Let's try the second one. The second one is equally interesting in the global perspective. Hussein, could you come in?
So, sir, there's a striking prediction in the global energy market which says that oil prices might potentially fall to $30 a barrel by 2027. Now, to give some perspective, oil prices have stayed relatively steady despite wars and geopolitical shocks and Trump tariffs, etc., hovering in the 60 to 70 range for much of 2025. But major financial institutions, especially JP Morgan, are warning of a possible sharp decline. So, why would oil, which usually reacts violently to conflict, suddenly crash? JP Morgan's model so suggests that oversupply is the biggest threat. They predict that Brent crude could average around $58 in 2026 and then it could slip further to about $30 by end 2027, which let me tell you is half the current price of roughly $62. Goldman Sachs is also aligned with this view. They are even recommending going short on oil, meaning they expect oil prices to fall even further. The underlying assumption of this premise is that either the OPEC Plus cartel loses its grip on controlling supply or it chooses to pump more oil into the market. Now, if that happens, the market gets flooded, and the US shale producers who already operate on tight margins will be squeezed badly if prices fall below $55 and 60. Importantly, so the cost of shale extraction itself may have been holding global prices in the current range. So, for example, if price rise above $70, shale producers ramp up production, putting a natural cap on prices. If prices fall below $60, they struggle and production slows. So, this creates a price band that normally stabilizes oil. But again, if global supply surges, especially from OPEC plus, that band could break. So the big question is, will supply side politics override market balance? And this is where the uncertainty lies because if OPEC plus miscalculates or if geopolitical players push out extra supply for strategic reasons, JP Morgan's forecast of $30 oil suddenly looks plausible and probable. Now, for oil importing countries like India, this is a double edged sword because low prices mean that cheaper imports and reduce inflation, but again, a sudden crash can also destabilize producing nations. It could disrupt global markets and it could affect global financial stability. Something an oil guzzling country like India would hope to avoid. What do you think, sir?
The oil sector is due for shocks, but I don't think the prices will go down below 40. Look at the chart. Four of the top 10 producers have average costs of over $40, well over $40, which means that as prices fall below 40, they will have to stop production. That means there's a squeeze on the markets. And if there's a squeeze on the markets, as you rightly said, Hussaina, you'll have supply mismatches. In fact, this oversupply issue is, I suspect, the reason why the US is fighting Venezuela so it does not start producing oil. And that's the reason why Trump is saber rattling against Nigeria so that it stops producing oil. And it has asked every country to stop purchasing Russian oil so that the oversupply is also curtailed. Because please remember, US is the most expensive producer of oil. So as a result, the entire strategy seems to make sure the prices won't fall below 50 because then US loses big time. I don't think they're going to fall below 40. So US may have to cut back some of the most expensive plants, including the shale gas producers, which means that the US may not be the largest seller and producer of oil. Okay, thanks. But Katya, any views?
So if it falls below that level, sir, the most affected will not be us who use oil, but we have a lot of companies which actually import oil, process it, and send it back. Those companies will be extremely affected
Yes,
because their
yes.
margins will be eroded.
Yes, but those companies have been prohibited from taking cheap Russian oil. So let us see what happens.
Right.
Very interestingly, I think these companies, and many other global players will try to reverse India's stand and allow Russian oil to continue flowing into India. Let us see.
Possible.
But very interesting times, and oil is going to determine many issues. Okay,
Right, sir.
let's go to the third story, and that is China's strategic grip on minerals. Saloni, could you come in?
Sure, sir. So China has tightened export controls on some of the world's most important minerals. A new report by the International Energy Agency shows that demand for minerals like lithium, nickel, cobalt, graphite, copper, and rare earth elements is rising sharply. These minerals are essential for electric vehicle batteries, renewable energy systems, smart grids, and the fast growing AI infrastructure. So, global industries are shifting to cleaner and smarter technologies recently. So, this is creating a high demand for critical minerals. In fact, energy applications alone account for 20% of total global demands of these key minerals. Energy networks, EVs, and solar panels are the biggest users. So, talking about China, between September 2024 and April 2025, it made strict rules on exporting minerals needed for semiconductors, green technologies, energy storage. In April 2025, China added even more restrictions. This scared Western countries because it shows how much the world depends on China for these minerals. Prices have gone up and down, but not dramatically, except for lithium. The lithium prices jumped 600% between 2020 and 2023. Then they fell sharply. Rare earth prices, rare earth metal prices, fell over the 13 years. Overall, the prices have not increased as much as expected because supply has increased a lot. The International Energy Agency states that demand is rising because energy applications require a significant amount of minerals. In 2024, EVs require 2,261 kilotons, electricity networks require 4,900 kilotons, solar panels required 1,658 kilotons, and wind energy required 592 kilotons. Together, they account for 20% of the total demand for key minerals. The IEA also says that demand for minerals will continue growing because more people will buy EVs, more renewable energy plants will be built, more energy storage and AI data centers will be created. So the need for lithium, cobalt, nickel, graphite, and copper will not reduce. Even if other countries mine minerals, China refines most of them. In 2024, China's share in refining was 70% of lithium, 78% of cobalt, 91% of graphite, 71% of magnet rare earths. So we can clearly see that China is the one who is dominating here. Even by 2040, China will still have huge control. China's dominance gives it the power to control prices, control supply, affect the availability of minerals, slow down Western technology industries, and even influence geopolitical decisions. So, when China restricts imports, Western companies suffer because their costs go up. They cannot build EVs or chips quickly. In short, they become dependent on China. The IEA also notes that China's dominance may fall slightly by after 2035, but will still remain extremely strong, about 82% on average for the top refined materials. There's also a major concern about China's pricing strategy. In a testimony to the US Congress, the CEO of Lithium Americas claimed that China deliberately depresses lithium prices to discourage investment in Western mining projects. If
Saloni,
true, it means
I'll have to
China.
interrupt here. I'll have to interrupt here because we've already overshot timing. But
Oh,
yes, it's a
yes,
very
sir.
important development. And it's a very important development for several reasons. One, the world does not understand that when the world was exploiting every mining country in Africa, especially, and Latin America, China was investing there, investing in developing the mines. So, today, if the world cannot make money from these countries, is it wrong for China to say, okay, fine, you want to hurt me, I can stop you? So, A, China was strategic to invest in these countries and to help them grow. And B, China is using this weapon only because the US tried to use its weapons unilaterally. And well, let's see what happens. But I think China is playing a very smart and a very far-sighted game, which the US and the whole of the world did not understand. Katya, any views on this?
So it's not just the critical minerals, so it's what they're doing with it. So recently they have come up with EV trucks. So EV trucks is a huge, huge breakthrough. And if that happens, it's going to hit where it hurts the diesel consumption, which is also probably why people have started shorting oil prices.
You're right. And in a way, let's see what happens. But China's game is not over. Watch the space very carefully. And that takes me to the end of today's session. We've woefully gone beyond the time limit that we have. But yes, do log in again next Saturday. And do watch a podcast on desalination. That's an important one that you should watch. And lastly, please log in once again next Saturday. Have a great weekend and a wonderful, profitable, meaningful week ahead. Take care. Good luck.